The Money Show.
Investment School.
Investment School's going back to basics this evening, and it's all about your money and how best to ensure that the money that you do have grows in value so that one day you can depend on that money. Creating long-term wealth is what it's all about. Nicole van der Munckhof is a certified financial planner from Independent Securities. Let's go right back. I don't know how far we go back to the beginning. Maybe the beginning, because it's the very best place to start, Nicole. We'll start singing songs that I remember from my youth. What is the first step toward this mythical idea of financial freedom?
Thank you, Bruce. The first step is really just to start. It's really just to take that first leap and to devise a plan and start. And it doesn't need to be complicated and it doesn't need to be overwhelming. It's just taking the first step, planning, and as you take that first step, your horizons broaden and you kind of you learn more and you get to do more things, and so you just build on that plan. But it's just taking that first step.
Now, for many people, taking that first step is putting money into a savings account in the bank, because I was told to save. And so I went to my bank and said, I'd like to save some money. Please, banks love other people's capital because they pay you a small amount of interest and lend it on to other people at much higher rates. So you're a perfect source of funding for the bank. When we're thinking about investing, we're thinking about something fundamentally different than going for a savings plan, right?
Yes, definitely. And when we're thinking about investment, again, it's just taking that first step. It doesn't need to be complicated. It doesn't need to be difficult. It can be as simple as just having a monthly debit order and investing in broad-based ETFs, which are exchange-traded funds, and just kind of getting yourself into the market over the long period on a consistent basis.
It doesn't have, as you say, when you say it doesn't have to be complicated, the vast majority of people, I think, are fairly intimidated by the plethora of products and offerings and complex terminology that is used to explain what particular investment options offer. And most people are quite intimidated by that. So when it comes to taking that first step, what is the first part of the first step, if I'm not being too basic about this?
No, 100%. So the first thing is you want to invest. So there are various structures that you can invest in. I think for most people, we know about a tax-free savings account, we know about retirement savings, and those are already steps in the right direction. You can also invest those funds in your own name, but it's really just as simple as opening up, be it a unit trust account, be it an ETF account, with any of the brokers that pretty much offer those. It's just very much going out there and doing it. So, the two easiest ones and the best place to start probably is retirement savings and making sure you are saving towards retirement. And then the second option is a tax-free savings account.
Tax-free savings account. So you will put that on as number two. Retirement savings, of course, making a tax-free donation every year to a retirement fund is the most logical thing to do ultimately with your money, because government gives you a little bit of free money to invest so that it doesn't have to look after you in your old age. At least that's the theory anyway. So certainly going into a pension fund, into a retirement annuity is a first step. But even in the retirement annuity space, with all of the rules and regulations that are around it, you also can't just go in blind. You have to be buying regulated products and products that are recognized by the South African Revenue Service as being compliant with, Regulation 28 of the Pension Funds Act.
Correct, yes. And it is important, as you say, to make sure that you are investing and buying into an approved FSCA fund that's gone through and has the label of being a registered pension fund. And then in terms of which funds you invest in and where to invest those funds, again, keep it as simple as possible. My advice to people is always, if you don't understand what you're investing in, you probably shouldn't be investing in it. So, again, a broad-based exchange-traded fund that tracks general markets or the top 40 or whatever the case may be, any indice out there or index out there, that's really the simplest way to do it, and it's the easiest way to do it. So you're going to get the return that the market is pretty much getting, and again, buying into that on a continual monthly basis gives you the advantage of rand cost averaging, which means you're entering the market at various phases in the market, which is great. And it helps to mitigate market risk, essentially.
What a lot of people like to do is wait until about the 25th of February, by which time hopefully they've done a calculation, and they go, right, I need to maximize I want to be even Stevens with the tax man, so I'm going to buy a retirement annuity for exactly the right amount so that I don't have to pay any tax into SARS this year. And they do it on the 25th of February, based on the fact that the end of the tax year is the end of February, and they squeak in at the final moment. But what they tend to do then is, instead of choosing a little block on the form that says, would you like to pay this in 3 months, in 6 months, in 9 months, in 12 months, they go, pay it all in right now because I want to put all the money into the market immediately. And they end up not getting that, what you call the rand cost averaging. They're not putting it in. So much better from the 31st of March every year to have the direct debit in for a fixed amount of money. You can always top it up if you've earned more in the financial year than you expected, but you can always top it up, on that 25th of February, right?
Correct, yes. And that's often the strategy that I advise people to take is, if you are reluctant to do a debit order, let's start with a smaller debit order, but I'm always going to push you to up that because it is important and it is a good investment strategy to follow. So yes, certainly get the debit order going, even if it's a smaller amount. As you say, you can top it up at the end of the tax year to maximize that tax benefit that you get from the contribution. But what people also don't know, Bruce, is that you get there is a disallowed contribution that you can also make. So if you do contribute this year more than the allowable amount, or the amount that you're allowed for a deduction rather, that rolls into next year, and then you can claim that as a deduction in the next year. So, another strategy and a good piece of advice is to when the grass is green and things are going well, put in a little bit extra, because maybe next year you won't. If you end up with extra contributions at the end of your retirement annuity, that then gets deducted off of any lump sum or annuity income.
This I did not know. So you can almost front load your pension.
Yes.
You're not going to you can do so, but you're not going to get the tax benefit all in this particular tax year. All you're doing is taking advantage of your extra cash, your positive cash flow, and then you will get the tax benefit in subsequent years, depending, of course, on how much you've popped in.
Yes, correct. And the great thing about that is that any growth on those funds are still free of tax. So if you had invested those funds in your own name, when you withdraw, there would be CGT. If you're in an equity portfolio, there would be dividend withholding tax. There would be interest on those funds, where if it's in a retirement wrapper, there's no tax on the actual growth within that wrapper, which is also great.
Which is so frustrating, and it's a trap we all fall into. I received my quarterly statement, for my retirement annuity. It came through yesterday just to tell me what happened in the first quarter of this year, and markets were very kind, and so it looks lovely. And then I compared it to a statement of about 18 months ago that I'd received, and I've gone absolutely nowhere. And it's knowing that in the fullness of time, whatever the fullness of time is, these things tend to sort themselves out. But it's depressing to watch markets going, it's very depressing to watch them going down, but also very depressing over periods of time to see them go sideways.
Yes, it's very frustrating when that happens, but it is the nature of markets, and that's why the earlier you begin and the sooner you get into markets, the longer you'll be exposed to market. The old adage, I think it's annoying at times when people say it, we get tired of hearing it, but it's really not timing the market, and it's time in the market. So,
absolutely. And just the discussion around starting early. Oh, goodness me, don't we all wish? Don't we all wish? Were you one of those nerdy kids, Nicole? Were you one of those nerdy kids who, at the age of 13, was making lemonade at the bottom of the driveway and putting it into investments?
No, I really wasn't. And when I was studying my undergraduate, investments was the last thing that I was interested in. You know, it wasn't this field that I wanted to go into. It was a module or 2 or 3 or 4 every year, but it didn't interest me at all. But it's one of those funny turns that life takes. I also said I would never marry a man from the hometown I grew up in, and I did. So that's life. Never say never.
Oh, all of these confessions coming through. What is this concept of tax loss harvesting? Sounds very impressive.
So it does. And basically all that this is realizing an unrealized loss, if you've got one, to offset a gain. So we know that capital gains, you've got the annual exclusion or the annual allowance of 40,000 that's excluded on an annual basis. So any gains that you've made up to 40,000 are not taxable. Thereafter, they're taxed at the highest effective rate of 18%. Right. So tax loss harvesting is basically where you go and you have a portfolio of shares or unit trusts or assets, any asset really, it doesn't matter. And there are a few assets sitting in with a negative return. It's then about realizing that return to offset that return against gains that you've made. And, you know, the reason you realize those returns, maybe you kind of hoping things will turn around, but they don't, and the things are taking long. So there's an opportunity cost. So that's really what that is. It does come with a little bit of a warning. It's something called the wash sale rule, Bruce. I'm not sure if you're aware of this.
No,
but basically,
do tell.
Yeah, what this is SARS monitors, and if you've exited, especially in an equity portfolio, if you've exited a share and you buy back into that share either 45 days before or 45 days after, within that time period, into that share, SARS will essentially ignore the sale and ignore the loss. So that's what the wash sale rule is. So it is important to make sure that you are aware of that and aware of that when making the decision.
And I also,
but it is an option.
I get fewer of these questions. I think I've answered them often enough for people to wise up to say, don't ask him that question. But it is the difference between investments and trading. The number of people who, over many, many years, have said, I want to learn to trade, because invariably they've seen some schmuck punting trading on Facebook or whatever the case is, simply so that they can be making lots of commissions for themselves as you go onto their platform. They don't care whether you make or lose money. They just want you to transact, and off you go. SARS takes one look at traders and treats them incredibly differently to people who are regarded as long-term investors, people who are perceived to be those putting money away for a rainy day, rather than simply trading in and out of positions, making occasional profits and occasional losses.
That's correct. And so how SARS treats traders is that any of the profits made within the trading is seen as income and taxed as income in your hand. So it'll be added to your taxable income. It will increase your taxable income, and you will essentially pay income tax on those funds. Capital is slightly different. When capital in nature, that is treated completely differently, and only a portion of the capital, so only 40% of the actual capital gain is included in income. So essentially, the maximum effective rate that you're going to pay there is 18%. So if your effective tax rate is lower, the effective CGT rate will also be lower, but the maximum is 18%.
Talk to me about retirement fund savings and when savings might be disallowed into retirement funds, because I think this is quite an important thing to understand.
Yes, and this is what we spoke about earlier with those retirement annuity contributions. And that's exactly when you are contributing above the 27.5% or 350,000, whichever's lower. And basically those contributions, as we mentioned earlier, they are rolled over to the next year. So if you keep rolling over, by the end of your working lifetime, when you reach retirement, you'll have quite a nice sum of money that you've saved up as disallowed contributions. So if you continually contribute in excess, those excesses will accumulate over time. SARS keeps track of those. And when you retire, you can either take a bigger lump sum. So if, for example, the first you've accumulated 300,000, you will get 300,000 at no tax. So if you look at tax tables, you'll have your lump sum. So add that to the lump sum that's taxed at a 0%, and basically it just increases the amount that you can access at retirement, basically.
Look, we all want to be able to access as much as we possibly can at retirement, and tragically only a tiny fraction of people will do so, because only a tiny fraction of people have been doing as you've been telling us we should have been doing for the last 20 years, 30 years, 40 years, even better. Then corporate actions. Why do we need to be paying attention to corporate actions? I've got enough to worry about here, Nicole. Corporate actions are something that occur very regularly. They're reported on the Stock Exchange News Service. Occasionally, we will report on the minutiae of corporate actions, of course, but most of the stuff is fairly uninteresting. And just because it's uninteresting doesn't mean it's not important. A lot of really important, quite technical, quite complicated stuff happens on a regular basis on stock markets. Why should we be paying attention to the minutiae of that?
Very simply, Bruce, when a dividend is issued and the cash is received, depending on the entity type, so if you're an individual, that's taxed at 20%. It's a withholding tax, so you as the investor, you get the net amount out, basically. If you're a company, there's no dividend withholding tax. So already there you can see, okay, there's something to consider here. So generally speaking, and just to give you an example, if a company issues a dividend and you get the option to either take cash or to take additional shares. If you take additional shares, you get those shares in. Effectively, what happens is your base cost is reduced. So when you sell those shares, you'll have a bigger gain. Okay, so remember we said earlier, capital gains are taxed at a maximum effective rate of 18%. Dividend withholding tax is at 20%. So already there's a slight difference. But when you take a cash dividend, you pay the dividend withholding tax now. When you take dividends, as in taking the shares, you only become liable for the capital gains once you sell the shares again. So effectively, you're doing two things. By taking a dividend, as in taking shares up, you are you're lowering the effective tax that you're paying on that, but you're also deferring that tax to when you actually decide to sell the shares.
Okay.
So there is that advantage. But again, it's if you're an individual, if you're a trust, this applies. If you're a company, it's a different consideration to be given.
Okay, and again, this is now we're going into the higher grade elements, of course, of investing, but it's all very valuable and very useful, Nicole. Do you have a retirement annuity? Or, as a financial advisor, are you somebody who has a retirement annuity?
No, I have a work provident fund, but I am always the one that contributes extra. And I also, if there are any bonuses or anything like that are issued to us, I'm also the one who always asks, okay, but please take a portion of that and put it safely away for me. So I have. Everyone in my household has a retirement annuity because they don't work for companies with pension or provident funds. It's their own responsibility. So them, I crack the whip.
Okay, excellent. You make them max out to the fullest the fullest extent that they can, their retirement annuities. Does everybody in your household have a tax-free savings account?
Yes, everyone in my household has a tax-free savings account. If I could, I'd open one for the dog as well.
I think that's illegal. You've checked. And then, do you run a private portfolio? Do you have a share portfolio, or do you find that to be distracting?
No, I have a private share portfolio, my own equity portfolio, and I started that very soon. So I've been working in this industry for about 10 years, and I opened it up, I think, I started in November of 2023, and by January of 2024, the account was open and up and running, and I started investing.
Who's doing better, your fund managers or you?
No, well, I mean, I sit with the fund managers, so we're probably doing about the same. But yeah, no, we're probably doing about the same. I listen to the best advice of my peers, and the portfolio managers around me. I have a few portfolios that I manage as well, so I'm very much, listening to the house view and listening to what my colleagues who have been in the industry for as long as the industry has existed, and they've always got great insight.
Thank you to Nicole van der Munckhof this evening, Certified Financial Planner at Independent Securities. Going back to basics tonight.